Is short selling an ethical practice? Presented by me, Ryan.
Me, Kieran.
Me, Joe. And me, Ethan.
First of all, we've got our contents page, which is going to show what we're going to go over, and at the end our overall thoughts on short selling.
Firstly, I'll explain what short selling is. Short selling involves borrowing a security whose price you think is going to fall from your brokerage and selling it on the open market to buy the same stock back for a cheaper price, profiting off the difference. Short selling is mostly speculation along with fundamental analysis and technical analysis. However, it could involve insider dealing and unethical tactics, begging the question, is it an ethical practice? An example of short selling is borrowing a security worth £100, speculating that the price will decrease, and then selling it on the open market. Then when the price of the security drops to 50, buying it back and returning the security, and then making yourself a nice profit of £50. Here are some commonly shorted stocks by Tesla and Apple. I got some data of the share price of Tesla and Apple from Yahoo Finance, and I put them in the graphs on Excel.
What is considered ethical finance? A few key aspects of ethical finance are honesty, integrity, transparency, reliability, impartiality, and these are all backed by the FCA, so every UK company should have these. However, some unethical financial practices are market manipulation, market abuse, insider trading, improper disclosure of information, misuse of information, distortion, and dissemination. However, some ethical financial practices are putting your clients first, being unbiased, avoiding conflicts of interest, and offering understandable information, which every UK financial firm should offer, especially if you're a financial advisor.
So is short selling ethical? When done ethically, short selling provides liquidity to markets and can prevent bad stocks from rising due to hype and over-optimism. It provides a clear expression on the view of the security, which also reduces volatility and risk of loss. Covered short selling is when the broker has already made the arrangements to borrow the securities before the sale. This shows integrity, reliability, and does not form any form of market abuse.
Naked short selling. Naked short selling is the illegal practice of short selling shares that don't exist. Usually traders must borrow a stock or confirm that it can be borrowed before they sell it to short. Due to various loopholes in the rules and discrepancies, naked shorting can still happen. These naked short sales are mostly done by options market makers because they need to maintain liquidity in the options market. However, these options market makers are often brokers or large hedge funds who abuse the options market maker exemptions. This is manipulated devices and lacks integrity. Another form of unethical short selling is bear raids. People have used short selling strategies and derivatives to artificially deflate prices and conduct bear raids on vulnerable stocks. This is market manipulation, which is illegal and therefore unethical. What a bear raid is an illegal practice which involves pushing the stock price lower through coerced short selling while spreading negative rumours about the company. A bear raid is sometimes undertaken by immoral short sellers who want to make quick money from their short positions.
As we all know, there's a huge war going on in Russia at the moment, and some people are taking advantage of this. For example, traders have been taking advantage of the war by short selling Russian exchange traded funds. So the Russian central banks plan to order to stop short selling Russian individual stocks, but they never stopped the ability of shorting ETFs. So traders have made roughly around 120 million off just 3 major ETFs. And on the following slide, there's an example of the VanEck Russian ETF, the main one, also known as RSX. And as you can see here, from the start of the war, a huge decline. And this is where the traders have made most of their money during this time.
We can see if short selling is done correctly and proper, it is classed as ethical by the FCA. However, some people may have moral issues with it due to again, the Russian war. People are seen to have benefiting of Russia invading Ukraine. Another issue of morality is in the 2008 financial crisis. A few proactive traders discovered a housing bubble and bet against the mortgage-backed securities, which led to them making hundreds of millions of dollars, while the majority of people in the financial crisis were left without jobs and some even bankrupt.
The positives and negatives of short selling. The obvious positives and negatives of short selling are that the investor can make high returns on their investment, which generates profits for themselves, as well as being able to make huge losses on their investment using short selling. Another positive being that short selling does not require high amounts of capital to invest. However, they need to take into consideration the higher the investment, the higher the risk and reward, and the lower the investment, the lower the risk and reward. Also, if an investor is short in their portfolio when a financial crisis occurs or other unpredictable events that affect the financial market, shorts can provide gains that cancel out the losses. A negative to short selling is that it requires a margin account to allow the investor to borrow from the brokerage firm. It can be easy for losses to get out of hand as the investor must meet the 25% minimum maintenance requirement. If the account goes below this, they must deposit more cash or liquidate their position. Short selling also goes against the general direction of the stock price on the market, so the investor is essentially going against the market trend. The final disadvantage is that there are underlying costs to short selling, such as margin interest, borrowing costs, and other payments on unpredictable events. A short squeeze. A short squeeze is an unforeseen event which triggers rapidly rising prices on a stock or security. It occurs when there is a significant amount of short sellers betting against the security, and opportunistic investors notice this and buy the stock and hold it, forcing the funds to lose out. For example, in 2021, the GameStop short squeeze occurred due to traders betting against the GameStop stock. This led to retail investors who coerced through a Reddit page, the Wall Street Bets Reddit page, buying the stock and pushing its price up. This led to big losses for the big funds and big gains for retail investors.
These are our overall thoughts. Short selling is a perfectly legal practice which is healthy for the market. However, some traders use unethical tactics and strategies in order to make quick money. There is also a question of morality, as while not technically done unethically, some short selling can be considered morally wrong.
Thanks for listening, and these are our references we've used